Hello, welcome back to the show. In today's video, I'll be covering some international stocks that I've been looking at. So for reference, this is my portfolio. I have majority of my holdings in the US, although I have some companies in Singapore as well, which I'll be talking about later on. I've been looking at some Chinese equities as well, which I'll be covering in this video. So if you haven't guessed it, your S&P 500, your Nasdaq, they are extremely overvalued today. So the Nasdaq, for example, is trading at a 32 times of earnings. S&P 500 is trading at a 27 times of earnings, and historically this is on the expensive side. But if you are to compare it to a country like China, China is currently trading at an 11 times earnings. So on a P/E ratio perspective, Chinese stocks are still massively undervalued as compared to your US companies. Besides that, if you're to do a world analysis, your European stocks as well as your American stocks, they're currently 2 standard deviations away from the average P/E ratio that they normally trade at, so they're historically expensive. Whereas for your Asia stocks, like in China, like in Singapore for example, they're still currently hovering around the average, which means that they are still relatively cheap as compared to your US equities. So the first stock that I'll be covering today is Alibaba. Alibaba is up around 48% year to date. It is currently trading at a 16 times of earnings. So for Alibaba, the thesis is extremely simple. So it's simply just the consumer spending in China recovering, as well as the company basically selling off its non-core businesses to concentrate its business into the 3 main components, which is your cloud, your retail, as well as your communications and media portion. So for Alibaba, we could see increased cloud activity given the growth in all its competitors. So a company like Baidu, for example, one of the competitors in the space, actually posted quite decent earnings in its cloud segment. Same thing for Tencent. So I expect something similar with Alibaba as well. If not, the stock is probably going to fall after earnings. But for all these Chinese firms, this is my problem with them. So a lot of your Chinese firms, what they like to do is they like to compete with one another. They don't want to hold an oligopoly. They want to have a monopoly. But when you try and steal market share from someone else, that other company will retaliate as well. So it's sort of like a price war where no one wins at the end. So for example, this is Taobao, this is Alibaba. Alibaba is trying to steal share from another company, which is Meituan. So they're venturing into the food delivery space as well. And although this could be seen as a good move from this management team, it highlights the inherent risk with all these Chinese equities, which is that they lack the ability to defend their own market share. So for example, in the retail segment, you have Pinduoduo, you have JD, you have Alibaba as well. All these companies, they can't really defend their share. What they've been doing actively over the years is to lower prices to gain more market share. And that has led to a price war, which is not good for anyone in the space. So that's my problem with Chinese equities, which is why I've been wary about adding into Alibaba. I think it's a decent quality business, but one that faces a price war ahead of it, which I dislike. The next company that I'll be covering today are your Singapore banks, namely UOB. So UOB year to date is down around 3%. You have your STI index trading up 15%, but for your banks, they're massively underperforming the index. So in Singapore, there isn't a fixed interest rate. This is moving based on the markets as well as the US dollar trading against the Sing dollar. So this is your Singapore risk-free rate, which is SORA. So SORA is currently now at a 1.2%, which is a historical low in the past 3 years. And on average, over the past 15 years, your SORA is actually at around 1.5%. So for all your Singapore banks, what they tend to do is they lend out money in Singapore dollars. So they earn the difference in terms of the interest rate there. And currently now, your interest rates are already all the way down to 1.2%. So there is very limited downside for all these Singapore banks in terms of its earnings. Of course, the valuation can compress, but earnings-wise, the downside risk is minimal already, simply because your interest rates have already fallen to such a low interest rate. So for UOB, for example, this is a dividend discount model. So the company is currently pricing in around a 5% growth in terms of its dividends over the next 5-10 years. And historically, the stock has been able to grow its dividends at around 8 to 10%. So I view this company as attractive today, and it is one that I'm actively looking at. I will probably swap some of my REITs to some of the banks as the REITs appreciate and as the banks go down because of their interest rates. So for UOB as well as all your banks in Singapore, they have a dividend payout ratio of less than 50%. In fact, it's currently only around 50%. So there's massive runway for growth ahead for all these different banks. They can pay out 60, 70, 80% easily without having to dig into their reserves. So this is the positive for all your Singaporean banks. They're well managed, and that's why I'm actively looking into them. The next stock that I'll be covering as well is Constellation Software. So Constellation Software year to date is now around 1.7%. It is currently trading at a price to free cash flow of around 28 times. So for Constellation Software, I mean the fundamentals are just incredible. Even at $100 billion market cap this year, the company has still been able to grow its free cash flow at 20%, which is amazing growth for any company. And for Constellation Software, the narrative now is that your software companies will be eaten up. But I beg to differ. I'm sure their CEO would have said something if he really thinks so. The CEO, Mark Leonard, is similar to Warren Buffett. He treats his investors like partners, not so much people that he claimed money from. So for Constellation Software, if you didn't know, Chuck Akre used to own the stock when he managed the fund. So this is what he said about Constellation Software. So he said that your vertical market software businesses benefit from strong competitive advantages. Constellation customers often rely on its software to manage their day-to-day operations, creating material switching costs and a high revenue retention rate. Switching costs increase for Constellation customers over time as the company continually tailors its software to its customers' vertical specific needs. The markets that Constellation software businesses operate in are usually quite small, limiting the potential for new competitive entrants. So clearly, Constellation Software is an amazing business. If you didn't know, Chuck Akre has around 10% of his entire portfolio in Constellation. It's not in the 13F, but this is what he mentioned on his fund. The next stock that I'll be covering as well that is on a small dip is Universal Music Group. So Universal Music Group is currently trading at an 18 times earnings, giving you a dividend yield of around 2%. So the stock is labeled as a white moat company by Morningstar. In your music industry, there is only 3 big players in the space. You have Warner Brothers, you have Universal Music Group, and you have Sony Music as well. So these 3 giants form the oligopolistic industry. Besides that, Universal Music Group, they collect recurring revenue. They have highly predictable streams of revenue coming into the business, and they own intellectual property as well. In fact, Spotify will have to pay Universal Music Group to list their music on the Spotify app. So it is very difficult for a competitor to come into the space. It is sort of like an oligopolistic position, and Universal Music Group is the biggest one of these 3 companies. The next stock that I'll be covering as well is Equifax. So this comment actually said, any thoughts on the risk and reward of FICO versus Equifax? So for Equifax, there are 2 main tailwinds for the company right now. The first one is the work number. So your work number has massive runways of growth because more people will start switching from physical employment data to more of digitalized employment data. And currently the work number has the largest resource in terms of this department. So the work number has been rapidly increasing the prices over the years. They have incredible pricing power simply because no other company has the data that they provide. So imagine you're trying to verify someone's employment history. Would you rather pay the $80 to Equifax, or will you pay the $40 to a competitor with a much higher risk of an inability to find the employee's data? So I'm sure most people will favor the convenience, and that is the mode of Equifax at its scale as well as the ability to have the data. Besides that, Equifax is also transitioning away from on-premise software. So previously, Equifax operated on sort of like an on-premise software service where people will pay upfront and they will allow the customers to build out their own servers and have their own maintenance. But currently now they're shifting to the cloud. So when you shift to the cloud, it not only helps with margins because you don't have to go down and build out the servers for them. It is also recurring streams of revenue coming into the business for Equifax because instead of just charging a one-time big licensing fee, you're charging a recurring revenue and elongating the lifetime value of the customers that you serve. So for Equifax, this is a tailwind. They have already finished building out this cloud, and there could be massive margin expansion over the next few years if this cloud continues to grow. So for Equifax, these are some ballpark numbers. So the company is now pricing in around a 14% growth. I think Equifax currently is around fair value. I wouldn't say it's overvalued. I wouldn't say it's undervalued as well. 14% growth is quite demanding, so I would wait for the company to drop to maybe around $220 a share or $200 a share before it looks interesting. Currently, I don't think it's an optimal entry price for this company. 14% growth is historically a bit high for a company like Equifax. Next portion, I'll be covering some questions left in the comments. So the first one it says, can I ask, how do you make passive income other than YouTube? In case of that, you can make a video. Also, if you guys are looking for a new brokerage account, if you guys are starting out investing, then you can try out Moomoo. If you deposit $100, you'll get $20 worth of Nvidia shares. I mean, it's free $20, so why not? I'll be making a small referral fee from this one, so if you're interested in signing up, click the link in the description to sign up now. So this is my YouTube revenue for reference if you're interested. I mean, I've made around $1,000 on this YouTube channel, nothing substantial. And if you're to divide it by the number of hours that I spend on here, it is lesser than working at McDonald's. Of course, it's purely passion at this point. I'm not doing this for the money. I'm not doing YouTube to try and make a living off of it for now. So I don't think this YouTube passive income is one that you will be interested in. The next comment, it says, 10 years average FICO PE ratio is 46, current PE ratio is 55, 10-year average price to free cash flow 34 times, current price to free cash flow 43 times, still too high for me, I need more discount for margin of safety. If we have a recession, lending and a need for FICO scores will drop significantly. We will see a huge drop in FICO stock price if a recession happens. Both FICO and Equifax are fairly valued right now. So I don't necessarily agree with the recession argument. I'm sure most stocks will fall, including all your different tech stocks. So that shouldn't be playing into your decision making when it comes to owning a stock. As for FICO's current valuation, I actually did a DCF calculation for this company, a full one. So we'll take a look at it. So this is my full DCF calculation for FICO. Currently now the company, I would say it's around fair value or so. So the company now, I would say it's around fair value. It's not significantly overvalued, neither is it significantly undervalued. But for high quality business like FICO, with the potential for massive margin expansion, I think it's decent to start a position today. And that's why I started a small position in this company. I'll be looking to add on the way down if the company continues to fall in stock price. I hope you guys have found this one useful and invest safe.